Imagine opening up your investment portfolio and seeing a massive, jaw-dropping return of 217.75% over the last 12 months. That is exactly the reality right now if you're holding Hecla Mining Company. A number like that, well, it doesn't just turn heads, it creates an absolute frenzy. It's the kind of momentum that dominates headlines and drives massive daily trading volume. But, a spectacular number like that is rarely the whole story. It's really just the cover of the book. Let's look inside.
Which brings us to a really fascinating mystery. Is Hecla Mining a gold mine, or is it a trap? How can a stock look like literally the greatest investment ever on the surface, while potentially hiding a massive fundamental disconnect just underneath? Are we looking at an unstoppable growth engine here? Or are we staring down a classic valuation trap where the hype has completely outpaced the mathematical reality? To answer that, we've got to bypass the noise and look directly at the data. Welcome to The Explainer. Today we're taking a structured, completely unbiased deep dive into the numbers behind Hecla Mining. We're going to examine the exact metrics driving this incredible price, but we're also going to shine a light on traditional valuation models that are, well, they're flashing some very bright warning signs. My goal here is to lay out the raw facts so you can understand exactly what's happening under the hood. Okay, let's dive into this. Here is our roadmap. First, we'll examine the growth explosion. Second, profit margins and health. Third, the valuation disconnect. Fourth, dividend realities. And finally, momentum versus math.
Section 1. The growth explosion. To really understand the momentum driving this stock to recent highs, we have to talk about their net income compound annual growth rate. Over a 5-year period, a 102.5% growth rate is already spectacular, right? Over 3 years, it climbs to 118.48%. But then you get to the trailing 12-month figure, an explosive, literally parabolic jump to 811.09%. This completely validates the market's initial excitement. This isn't just internet meme stock hype. There is a real, massive surge in recent net income happening right now. And that income surge translates directly to the shareholder level. The trailing 12-month earnings per share growth is an absolutely staggering 960.97%. Now, EPS is often considered the primary fuel for a stock's momentum. So when momentum investors see earnings multiplying nearly tenfold in a single year, yep, they buy in. This single metric explains the aggressive upward trajectory of the stock price better than anything else. Moving to Section 2, profit margins and health. Massive growth is fantastic, absolutely. But is the financial engine actually healthy? Well, the vitals here are actually quite impressive. Let me translate these metrics for you really quick. A debt-to-equity ratio of 0.11 means they operate with incredibly low debt relative to shareholder equity. A current ratio of 2.72 means they have $2.72 in liquid assets for every single dollar of short-term liabilities they owe. Their quick ratio of 2.22 further proves they can easily cover obligations without needing to sell off any inventory. Basically, Hecla is running a very stable, highly liquid ship. And this brilliantly illustrates their current operational efficiency. Return on equity measures how effectively management is using your money, shareholders' money, to generate profit. The trailing average was sitting at a pretty modest 5.98%, but the current ROE has more than doubled to 12.39%. So not only are they growing fast with low debt, but they're getting significantly better at turning equity into actual profit. Now for Section 3, the valuation disconnect. This is where our financial detective story takes a really sharp twist. Before we drop the hammer on the valuation numbers, let's just make sure we're on the same page regarding the margin of safety. It's simply the difference between what a company is intrinsically worth, based on its actual cash flows, and the price it's currently trading at on the open market. A positive margin? You're buying at a discount. A negative margin, you are paying a premium. Right now, Hecla Mining has a margin of safety of negative 279.91%. Let that sink in for a second. According to strict fundamental analysis of their cash flows, the market is pricing this stock at a massive premium compared to its intrinsic value. And this firmly establishes the paradox we're exploring today. How can a healthy, fast-growing company be this wildly overvalued by traditional models? When we break down that gap into real dollars, the disconnect becomes staggering. The stock recently closed at $18.62, but if you run a discounted cash flow model, which calculates fair value based on future cash generation, the fair value price sits at just $4.90. If you base fair value on earnings per share models, it drops even lower to $3.87. The market is completely ignoring these conservative mathematical models. This market optimism is reflected perfectly in the PE ratio, which sits at 38. Investors are gladly paying $38 for every $1 of current earnings. The forward PE of 23.64 shows that the market expects future earnings to catch up somewhat, making it cheaper over time, but it still remains a really hefty premium. The market is essentially betting that Hecla's explosive growth will continue indefinitely, completely overpowering the current mathematical fair value.
Section 4. Dividend Realities. So, we've talked extensively about valuation, but what about the actual cash being returned to you, the shareholder? Well, the picture for dividend growth is incredibly stark. Despite the explosive 200+% stock price growth we discussed earlier, dividend growth has gone in the exact opposite direction. Over a 5-year period, the compound annual growth rate for dividends is actually negative 15.55%. And over the last 3 years, as well as the trailing 12 months, dividend growth has entirely flatlined at exactly 0%.
This results in a microscopic current dividend yield of just 0.08%. Now, this metric reinforces a vital point for anyone looking at this company. Hecla Mining is entirely a capital appreciation momentum play. The company is reinvesting its cash or holding it rather than paying it out. If you are an investor seeking stable, growing income, the fundamental data clearly shows this is not the asset for you.
Finally, Section 5, Momentum versus Math.
All right, so the crucial point is synthesizing all of these data points together. We have a fascinating duality. On one side, you have the boom, a staggering 264% total return over the last 12 months, fueled by an undeniable 811% explosion in net income. It's a phenomenally healthy, liquid company growing at a breathtaking pace. But on the exact opposite side, you have the warning, a terrifying negative 279% margin of safety and fair value models suggesting the stock should literally be trading at a quarter of its current price. It is a perfect demonstration of market psychology versus discounted cash flow mathematics. The market is pricing in a flawless, high-growth future, while the math is demanding a return to reality. So, which side is right? Well, that depends entirely on your own investment philosophy. In a clash between soaring momentum and strict traditional valuation, which numbers do you trust? Thank you for joining me on this explainer. Keep learning, keep analyzing, and I'll catch you next time.